Euro to US dollar just broke 1.1500, and 66% of retail traders are short. That's the biggest contrarian signal I've seen this year. The Fed is about to cut aggressively, but what if NFP surprises hot? I'm watching 1.1580 for the real breakout confirmation. Full analysis with my exact entries, stops, and profit targets is on the main channel. Link in the description. And I'm calling it now. If we close above 1.1580, 1.1700 is coming fast. Don't get caught on the wrong side. The market is screaming in one direction. And as I sit here watching the Euro to US dollar trade at 1.1556, up 42 pips on the session, I can't shake the feeling that something about this move just doesn't sit right. Not because the technicals are wrong. They're actually beautiful. But because the retail crowd is 66% short. Think about that for a second. 2 out of 3 retail traders are betting against this breakout. In my 20 years at this, I've seen this exact setup play out more times than I can count. The crowd gets convinced they're smarter than the market, loads up on a position, and then gets completely steamrolled by institutional liquidity. But here's where it gets interesting. This isn't just a random move. We've got the dollar getting absolutely crushed on Fed rate cut expectations, the ECB standing firm with hawkish undertones, and a geopolitical risk-on mood that's sucking safe haven flows out of the greenback. The daily chart has broken out of a multi-month consolidation base that had trapped bulls since early spring. The weekly trend is riding a steep structural upward channel with every single moving average stacked in bullish alignment. This is the kind of setup that makes institutional traders salivate, and yet, that retail sentiment number is flashing warning signs. Not a sell signal necessarily, but a caution flag. Because when retail traders all pile onto one side of a trade, the market has a nasty habit of delivering exactly the opposite outcome. I call this the liquidity trap setup. The smart money is probably already long from much lower levels. They've been accumulating since 1.1200. Now they're looking at a market where amateurs are aggressively shorting strength, and they're seeing the perfect opportunity to squeeze every last dollar out of these bearish positions. The question I keep asking myself as I look at these charts is simple. Is this the real breakout that takes us to 1.1700 and beyond, or is this a fakeout designed to trigger stops and shake out bulls before a violent reversal? Let me show you exactly what I'm seeing across every time frame, because I promise you, the answer is in the levels, not in the noised MY bias. Here is clearly bullish, but with a very specific caveat that I want you to tattoo on your brain. I am bullish above 1.1500, and I'm looking for a continuation to 1.1620 and then potentially 1.1700. However, my invalidation level is a daily close below 1.1400. That's the line in the sand that would tell me this whole thing is an institutional fakeout designed to trap retail buyers. I've seen this move before. The August 2022 squeeze fooled everyone, and I got caught on the wrong side of that one. I made a mistake that cost me 2 months of profits, and I never forgot that lesson. The macro picture is overwhelmingly supportive of dollar weakness. The Fed is basically telegraphing aggressive rate cuts to prevent an economic slowdown that everyone on Wall Street is starting to whisper about. The bond market is already pricing in 90 basis points of cuts over the next 12 months, and that's a massive headwind for the dollar. Meanwhile, the ECB is sitting there with sticky core services inflation that just won't come down, forcing them to maintain a hawkish stance that's narrowing the transatlantic yield spread. But here's where I want you to focus. The NFP report tomorrow is the catalyst that will either validate this breakout or trigger a violent USD short squeeze that could send this pair back down to 1.1400 in a hurry. This is one of those moments where the market is priced for perfection on the bearish dollar narrative, and any deviation from that script could cause chaos. Let me break down exactly what I'm watching across the charts. Let me take you through the chart structure starting with the weekly time frame. This is where the big picture is painted. The weekly trend is unambiguously bullish, with price riding a steep upward channel that has been in place since the December lows. Every single moving average is stacked perfectly. The 5-week at 1.1542, the 10-week at 1.1510, the 20-week at 1.1465, the 50-week at 1.1395, and the 100-week at 1.1310. Price is trading above all of these reference levels, which tells me that trend-following systems are firmly in buy mode. What really stands out to me on the weekly is the structural breakout above 1.1500. This isn't just a random psychological level. This is a barrier that has rejected price 3 times since February. The fact that we are now trading above it with conviction suggests that the underlying supply at that level has been completely absorbed. This is the kind of breakout that institutional traders look for as a confirmation of a longer-term trend reversal. Moving down to the daily chart, the picture gets even more interesting. The RSI is sitting at 66.80, approaching official overbought territory. Now, before you panic, let me tell you something I've learned from watching this market for 2 decades. Overbought doesn't mean sell. In a strong trend, RSI can stay overbought for weeks, even months. What I'm watching is the MACD histogram at plus 0.0034, which confirms that bullish momentum is accelerating. The ADX at 31.40 tells me the trend is strong, not just strong but actually gaining strength as we move higher. The CCI is at plus 138.50, which is elevated but not extreme. This tells me that momentum is powerful but hasn't yet reached the kind of blow-off levels that precede significant reversals. I'm seeing a classic trend extension pattern where each pullback is shallower than the last, and each rally extends to new highs. That's the hallmark of a healthy trending market. Now let me zoom into the 4-hour chart because this is where the trading decisions are made. The 4-hour structure is showing a bullish continuation pattern with higher highs and higher lows above the short-term EMAs. The price action here is clean. We are forming what looks like a flag pattern directly under the 1.1580 resistance level. This is the kind of consolidation that typically resolves to the upside, especially when it's happening after a powerful breakout that I've got my eye on the 1.1580 level specifically. This is the intraday ceiling that has rejected price twice in the past 24 hours. What I want to see is a 4-hour candle close above this level. When I see that, I know the buyers have completely overwhelmed the sellers, and we should see an immediate acceleration to 1.1620. The volume confirmation is crucial here. I want to see expanding volume on the breakout candle to confirm that institutional money is driving this move. Down on the 1-hour chart, we are in a consolidation phase. The intraday flag pattern is forming, and the price action feels like a coiled spring. The 1-hour trend is neutral consolidation, meaning we could go either way in the short term. But with the higher time frame trends all bullish, the path of least resistance is clearly to the upside. I'm watching the 1.1528 pivot level as the immediate support. A break below this and we could see a quick dip to 1.1500 to flush out weak longs before resuming the uptrend. The moving averages on the daily chart tell a compelling story. The 50-day EMA sits at 1.1395, and the fact that price has moved more than 150 pips above this level tells me the trend is well established. The 200-day at 1.1240 is even further below, creating a massive cushion that would need to be broken for any real bearish reversal. What I'm watching for is whether the weekly channel continues to hold. The upper boundary of this channel is currently around 1.1700, which aligns perfectly with the major macro extension level. This is where the institutions are likely targeting for profit-taking, so I want to be cautious as we approach that zone. What fascinates me about this current setup is the timing. We are breaking out of a massive consolidation base just ahead of the most important economic data release of the month. The NFP report tomorrow is going to be the catalyst that either validates this breakout or triggers a violent reversal. I'm reminded of a similar setup back in April 2023 when we had a breakout ahead of CPI, and the data came in hotter than expected, causing a complete reversal that wiped out 3 weeks of gains in a single day. I got caught in that one, and I learned to respect the calendar more than any chart pattern. Let me shift gears here and talk about the real drivers behind this move because this is where the money is actually being made. The dollar is getting absolutely crushed right now. And it's not because of technical factors. It's because the bond market is screaming that the Fed is behind the curve. US yields are collapsing as traders price in an aggressive rate cut cycle that could see the Fed funds rate drop by nearly a full percentage point over the next year. The 10-year Treasury yield has fallen dramatically over the past week, and that narrowing yield spread is making the euro much more attractive to global capital flows. Think about it. If you're a global portfolio manager, why would you hold dollars when you can get similar yields in euros with the added bonus of currency appreciation? This is exactly the kind of structural shift that creates multi-month trends. The ECB is contributing to this dynamic with their hawkish undertones. Core services inflation in the Eurozone remains stubbornly elevated, and the ECB has made it clear that they're not going to rush into cutting rates just because the Fed is doing it. This policy divergence is a massive tailwind for the euro, and I don't see that changing anytime soon. Geopolitical factors are also playing a role. The risk-on sentiment that has emerged following recent de-escalation in the Middle East is reducing safe haven flows into the dollar. The dollar has traditionally been the go-to safe haven during periods of geopolitical uncertainty, but when investors feel confident enough to move money into riskier assets, the dollar tends to weaken. Now let me talk about the calendar because this is where things get critical. Tomorrow we have the Non-Farm Payrolls report, and this is the single most important data point of the month. The market is expecting a soft print, something in the range of 100,000 to 120,000 jobs added. If we see a print below 100,000, the dollar is going to get slammed. Institutions will aggressively price in a September rate cut, and I would expect euro to US dollar to blast through 1.1620 and head straight for 1.1700, but here's the contrarian play that I'm watching closely. If NFP comes in above 150,000, we could see a massive USD short squeeze. The current positioning is heavily skewed short dollar, and a hot print would force those shorts to cover in a panic. I've seen this happen more times than I can count. The retail crowd gets positioned one way, the institutions are also leaning the same way, and then the data delivers the opposite of expectations. The resulting squeeze can be absolutely brutal, and it can happen in minutes. Prior to NFP, we have the weekly initial jobless claims report today. This serves as a leading indicator for tomorrow's print. If claims spike higher, it reinforces the softening labor market narrative and sets the stage for a weak NFP. If claims come in lower than expected, it might signal that the labor market is actually more resilient than the pessimists are predicting. Then we have the Fed chair testimony later today, which could move the markets significantly. The Fed has been trying to maintain optionality, but the bond market is already pricing in a dovish outcome. Any hint that the Fed is more concerned about economic slowdown than inflation could send the dollar even lower, and we can't forget the Eurozone data. German factory orders and Eurozone retail sales will give us insight into whether the Eurozone economy is showing signs of stabilization. The ECB has been clear that their hawkish bias depends on economic data, so if we see weakness in Eurozone data, that could limit the euro's upside potential. This is a classic by the rumor, sell the news setup. The dollar has been weakening on expectations of dovish Fed policy, but tomorrow's NFP print will tell us whether those expectations are justified. If they are, we continue higher. If they're not, prepare for a violent reversal. Scalp setup 1. The pre-NFP dip buy. Here's my first scalping setup for today. I'm looking to buy pullbacks into the 1.1520 to 1.1530 zone. This is the daily pivot block that has already shown support in the Asian session. The rationale here is simple. The path of least resistance is long ahead of the employment data, and any meaningful pullback is likely to attract dip buyers looking to position for a soft NFP print. The entry trigger is pretty straightforward. I want to see price pull back to this zone and then show rejection on the 15-minute chart. I'm looking for a bullish candle pattern like a hammer or a piercing pattern, or just a clean bounce off the level with volume confirmation. I'll be watching the price action closely because I've seen these setups fail when the retracement is too fast and too sharp. My target is a fast 40 to 50 pip scalp back up to the local resistance at 1.1575. This should be a quick in and out trade, probably lasting a few hours at most. The risk-to-reward ratio here is excellent. We are risking about 20 to 25 pips to make 50 pips, which is roughly 2 to 1. The stop-loss is set at 1.1495, managed tightly below the 1.1500 structural psychological cushion. I've learned from painful experience that stops below major psychological levels are vulnerable to being taken out. so I'm placing my stop a few pips below that level to avoid being stopped out on a temporary spike. The 1.1500 level is the line in the sand for this whole bullish thesis, and if we break below it, I want to be out of this trade immediately. This is a low conviction scalp that I'm trading with smaller size. I've been doing this long enough to know that trading ahead of major news events requires humility. I've been burned before by getting too aggressive before a data print, so I'm keeping my position size small and my expectations realistic. Scalp setup 2. The post-NFP volatility chase. This is the higher conviction setup that I'm really excited about. The plan is to wait for the NFP print and then chase the momentum in whatever direction it breaks. This is a pure momentum play that requires quick reflexes and strict discipline that if the NFP print misses forecasts, causing an immediate dollar drop, I'm looking to buy a clean 5-minute candle closing firmly above 1.1585. This tells me that the breakout is real and that institutional traders are aggressively buying the news. I want to see acceleration of price movement. I want to feel the urgency in the candles. The target is a rapid extension straight toward 1.1620. This is the multi-month high, and if we break above 1.1585 with conviction, I believe we'll slice through 1.1620 like butter. There's very little overhead resistance between these levels, so momentum traders will push the price aggressively higher. The stop loss is set at 1.1550, giving the trade enough room to breathe while still protecting capital if the move reverses. This is about 35 pips of risk to make 35 to 50 pips, so the risk-to-reward ratio is around 1 to 1.2. This is a lower R ratio than I typically like, but the speed and probability of this trade make it worthwhile. When you get a trend acceleration on major news, the momentum can be explosive. What I'm watching for is the 5-minute candle close above 1.1585. A close above that level tells me that the sellers at the intraday ceiling have been overwhelmed. The smart money is stepping in aggressively, and I want to be riding that wave. Swing setup. Ride the structural breakout now. This is the setup I'm most excited about because it has the potential to capture significant profits over the coming days and weeks. The strategy here is simple. Ride the macro structural breakout above the multi-month 1.1500 consolidation base. I want to accumulate exposure on key structural retests to ride the long-term trend continuation. The order entry zone is 1.1440 to 1.1470. This might seem like a wide range, but it represents the optimal risk-to-reward entry, capturing a clean technical retest of the old resistance turn support channel. I'm layering limit long orders within this range, meaning I'm setting buy orders at specific prices inside this zone. I want to be accumulating as price retests these levels. The logic here is straightforward. We've broken above a major resistance level that held for months. When you break above a resistance level, it typically becomes support. The institutions will be watching these levels for retests, and I want to be in line with their orders. I've seen this pattern play out countless times, the breakout, the retest, and then the continuation. The take profit target is a multi-day trend continuation targeting the major extension level at 1.1620. This is my first target, and it's a reasonable expectation given the strength of the breakout and the supportive macro backdrop. I'll be taking partial profits at this level and then leaving a smaller runner open for a macro test of 1.1700. The invalidation point is a verified daily close below 1.1400. This would completely break this macro bullish thesis, pointing to an institutional fakeout. If we close below this level, I'm liquidating all swing long configurations. I've learned this lesson the hard way. A daily close below a major support level is not something you ignore. It's the market telling you that your thesis is wrong, and you need to get out. What I love about this swing trade is the risk-to-reward ratio. We are risking about 70 pips from entry to invalidation, and we are targeting 150 to 200 pips. That's roughly 2.5 to 1, which is excellent in the Forex market. If we hit 1.1700, we are looking at a 4 to 1 trade, which would be a home run. I'm going to be patient with this one. I'm not going to chase price at these elevated levels. I've seen too many traders buy at the top of a breakout and then get shaken out on the first pullback. I'm waiting for a retest because that's where the real institutional buyers will be stepping in. The traders who bought the breakout will be taking profits, and the new buyers will be stepping in at support. Let me take 30 seconds to talk about something that doesn't get enough attention in the trading world: risk management. This is the most important conversation you'll ever have about trading, and I'm speaking to you as someone who has blown up an account and had to rebuild from scratch. I'm not proud of that moment, but I'm grateful for the lesson. When you're trading these setups, position sizing is everything. My golden rule is to risk no more than 1% of your trading account on any single trade. Not 2%, not 5%. 1%. I've seen too many traders blow up their accounts because they got overconfident and went too big. I remember a trade back in 2019 where I had a perfect setup, but I got greedy and risked 3% on a trade. The market went against me, and I lost 3 months of profits in a single day. I learned that position sizing is the difference between surviving a losing streak and blowing up your account. For the scalping setups, I'm trading smaller size because the speed of the trades means I need to be able to get in and out quickly. The swing trade is where I allocate more capital, but even then, I'm keeping my risk consistent with my overall portfolio exposure. I'm also using trailing stops on the swing trade to protect profits as the trade moves in my favor. I don't just set a stop loss and forget about it. I'm actively managing my risk, moving stops to break even once the trade is up 50 pips, and then trailing them higher as the trend develops. This protects my capital while still allowing the trade to run. Let me close this out by emphasizing the key levels you need to be watching. The 1.1580 intraday ceiling is the immediate hurdle. A break above this, especially with the catalyst of a weak NFP print, opens the path to 1.1620 and then 1.1700. But don't forget the downside scenario. If we break below 1.1500, the bullish thesis is at risk, and a retest of 1.1440 becomes highly probable. The real catalyst is tomorrow's NFP print. This is one of those binary events that can define the trend for weeks, even months. I'll be on the desk watching the print in real time, and I'll be sharing my immediate reaction on my community post as soon as the data is released. If you want to get my real-time read on the market, make sure you've subscribed and turned on notifications so you don't miss it. Here's my promise to you. I'll be back on Friday with a full NFP reaction video, breaking down exactly what the data means for the USD going forward. And on Sunday, I'll be posting my weekly market prep, covering all the major pairs and setting up the trades for the week ahead. If you got value from this analysis, I'd appreciate you hitting that like button. It helps the algorithm show this to more traders who actually need this kind of institutional level analysis. And if you haven't already, smash that subscribe button and turn on the notification bell so you never miss an update. This is the kind of analysis you won't find on mainstream financial media, and I'm here to give you the institutional edge that most retail traders never get access to. I've been doing this for 20 years, and I've learned that success in this game is about discipline, patience, and a healthy respect for risk. The setups I've shared today are what I'm actually trading with my own capital, not some theoretical strategy that I'm just talking about. I'm putting my money where my mouth is, and I'm sharing that with you in real time. Remember the key levels: 1.1580 resistance, 1.1528 pivot, 1.1500 support. The NFP print tomorrow determines the direction. Soft print means aggressive dollar selling. Hot print means USD short squeeze. I'll be ready for both, and I hope you will be too. There's a reason why I do this, and it's not just about the money. It's about mastering a craft that most people will never understand. It's about the discipline of standing alone in your conviction when the crowd is screaming the opposite. And it's about sharing that journey with people who actually get it. I'll see you in the next one. Stay disciplined, stay patient, and may the trades be ever in your favor.